Good morning, everybody. Welcome to Tuesday. Morning, Kay. How you doing, mate?
Good morning, Ryan. All good, thanks. Yourself?
Yeah, well, a bit weird today. I feel like a central bank today. I feel like I'm behind the curve and can't get anything done. I'm playing catch up. been like that since I dropped the kids off at school, so I'm feeling a bit scatty at the moment.
The way
Might
I
need your
call
help
it is
more than normal.
the way I call it is that the markets are not talking to me today.
They're talking gibberish. So I hope everyone else has got a clear enough mind today. Welcome to those who are new to the show. I hope you're enjoying it, and welcome to all our regulars. Big thank you to everyone for coming. Just to start off with, if you want to come and join us in the ForexAnalytix platform, you can see on the screen now the link and the details of what the ForexAnalytix platform offers. If you want to have a look at that, please feel free to do so. That's on the forexflow.live site. If you want to grab a discount there too, I've got a special offer on for anyone who comes via that link there, 20% off your subscription for the lifetime of your subscription. Please have a look at that there. And also the funding program, traders funding program. You can find details of that also on the forexflow.live site. Gives you a bit of information there. You also get to hear from Blake, and just gives you a bit more details there. Click the links to follow through and see what it's all about. It's been something that's been so far a great success for some of our traders, and some of the guys and girls here on the show in the comments are in the program as well, doing very well. Not everyone passes. We're very honest about that. But what we want to try and do is give you guys a better crack at it, really, to learn how to get that discipline nailed down, that foundation nailed down, so then you can use this program to leverage up your trading. We also give you the support of, depending on which assessment you take, you get free access to the ForexAnalytix platform, which will help you along your journey. So if you want to give that a look, check that out on that page there. What we'll do now, just jump through to some of the headlines and the data that's out, a quick brief look, as we usually do, some of the fundamentals. Start with Japan today. Industrial production came in a little bit soft today. It was soft last month. It's a bit worse this month. So really nothing there that's looking positive at all on that side of things. We had some comments from the finance ministry, from Suzuki, pretty much the same old lines we've had recently. They had stepped up a tiny bit in rhetoric, but nothing that's going above and beyond what we've heard recently. Bit of a funny goings on yesterday, because we saw JGB moving up well above the 0.25% mark, which is the BOJ's line in the sand. Bit of a strange move, because the secondary market wasn't open, or we don't think it was open. So where that price was derived from via some of the main wires and trading view and that sort of thing, we're a bit not sure about. But pretty much in the evening, when Tokyo came online, yields moved right back down, and we heard that the Bank of Japan stepped in with a record amount of JGB buying today. So not sure what went on there. I'm looking into it to see if we can find out whether those prices were actually traded or not, or whether they were sort of indicative numbers. But we'll look at that. Definitely the pressures on the Bank of Japan, particularly with all the rising expectations for other central banks, which I'll talk about in a moment. Over to the UK, we had the drop of the Brexit protocol legislation yesterday late afternoon, pretty much as expected, and the response from the EU was pretty much as expected. Now, you may be seeing a lot of headlines: the UK is going to break international law and break the protocol and this and that and the other. But as usual, the shouting from the rooftops, let's call it, is never quite as clear as what it says. Right now, this is just legislation that potentially would lead to Article 16 of the protocol being invoked. If you're not sure, Article 16 is part of the protocol that allows either side to take measures if it fulfills certain negative conditions. So if there's certain negative things in the economy, in social unrest, that sort of thing, that's being created by the protocol, people, both sides, are allowed to take action. Now, this is something that the EU pretty much triggered back in 2021 when we were getting the vaccines, because they wanted to stop the potential exports of vaccines, Euro-produced exports, coming through Northern Ireland to the UK. And so they put in place an order to halt that. And now that would have triggered Article 16 of the protocol. Now, back then, no one was screaming that they were breaking international law. There was a lot of hoo-ha, both from European nations, and the European Commission and von der Leyen actually did a U-turn on it, reversed it, and issued an apology that they took that line. It may be a case they didn't realise what they were doing, but they came within an inch of actually triggering Article 16 themselves. And so far, the UK has just tabled legislation. So this is purely on the UK side, where they're discussing these issues. And if these issues become law, if this legislation becomes law, that they want to change certain aspects, then I believe it goes into triggering Article 16. So right now, Article 16 hasn't been triggered. There are no international laws been broken. And it's unlikely international law will be broken anyway, because Article 16 is there for that exact reason that the UK are using. Now, what comes of it, I don't know. How far the UK goes and whether it does eventually break parts of the protocol or clauses that are not allowed, we'll wait to see what comes from that. But for the moment, the UK is, I think, using it pretty much as a tool to push the EU into further negotiations or getting more out of the EU, but we'll see where that develops. As far as the price action goes, the pound did have a little bit of a minor wobble on it. We knew it was coming. We knew what the response from the EU was going to be. It's just another weight around the neck of everything else that's bearish for the pound at the moment, but no real huge driver when that came out. As far as the rest of the data, Germany CPI pretty much came in confirming what we already knew, the final numbers there. We had the Eurozone, the German ZU coming in as well. Not as bad as last month, still negative. So, no real improvement there in positive terms. Still a negative number. It's just not as crap as it was last month. We had ECB's not coming out. He's one of the hawks, and he was saying that they may need to do more in July than 25 pips. And he's also thinking that further hikes are coming in October and December. As far as I can tell, as I say, I'm a bit scatterbrained this morning. I've not seen any other major news. I don't know if you've got anything to add on that, Kay. Have you seen anything yourself?
Absolutely nothing at all. We just had the RBA low out saying that they need higher rates for inflation to come down, and he says, warns it is unclear how high interest rates will have to go. So he's as clear as all the rest of the central bankers. And moving on.
Morning, chaps.
Morning, Stel.
Hello, how are you?
I'm good, mate. All good. I'm glad you're here. I wanted to pick your brains over a couple of your crypto comments in the room.
Oh, yeah. Okay. One thing I wanted to say about the UK and sterling, I think you're absolutely right. There's very few reasons to be bullish sterling. And if you are, you're expecting one of two things to happen. Either A, the economic data starts improving and the UK economy starts improving, or B, the MPC, the Bank of England, starts getting more aggressive. Now, I think for the data to start improving, that's pretty much out of the question at the moment. If anything, things are slowing down. You saw average earnings dropping as well, while inflation is going higher. This is not a good. It's not a good scenario. So, do you think the Bank of England is going to turn more aggressive? It could. could happen, but the Bank of England is the Bank of England, and they've always been, always on the dovish side as much as they can, and they still are. If you look at the ECB, there's people now like not talking about 50s coming, and on the Bank of England side, it's not really happening yet. So I'm still, even with the pound having dropped so much, especially against the dollar, I still don't see any reason to be buying it. And I still think euro pound long is the way to go. And it's going again today. And I'm not going to repeat. I think we're going to get to the 90s. So I said it. So what do you want me to? What do you want to talk about? Cryptos, my favorite asset class.
Okay, was you about to say something there?
Yeah, I said as long as Bailey is in charge of the Bank of England, even if GDP would be at 10%, it would still weigh on the sterling with him around.
We used to say the same with Carney, didn't we? I mean, anyway, it's
It's a feature of the UK. The glass is always half empty rather than half full. But at times, a lot of the market and a lot of the commentary can get far too bullish, far too bearish over the UK than is actually needed.
Yes.
I think it might be heading that way myself. And we have become the poster child for what rate hikes will do to an economy, because we're seeing it happen faster in the UK, potentially faster in the UK than anywhere else. So everyone's going to be drawing comparisons between what happens to us and what's going to happen elsewhere. But then again, I just forgot to mention we had the employment numbers out today, and they weren't too bad. I've got them on the screen there. The claimant count was down. The unemployment change was up. The unemployment rate ticked up a tiny bit. Nothing really bad there. Wages are holding up fairly well. So, we're not disappearing into a fiery abyss just yet.
Yeah. I think there will come a time to buy sterling and to buy aggressively as well, but I just don't think it's time yet.
Yeah, most definitely. I think the big risk for sterling to the upside is if we get a disappointing Fed, but we'll look at that in a bit when we look at the pricing and stuff. Just a couple of your comments you had in the chat room about cryptos. So you're not feeling that this is a bottom then?
Well, the bounce or the attempt of a bounce is feeble. It's the same with equities as well today. Do I think it's the bottom or not? As long as the Fed is still tightening and as long as they continue with what they've told us, I don't think I wouldn't want to be buying anything in terms of risk assets, and that includes cryptos. Now, I do think, if you remember, we've been talking about this for the past weeks, and I've said, the Fed is driving everything, and they're going to tell us when things are when the time is here to buy risk assets, and I've been saying that I think that this U-turn that the Fed will make is going to come earlier than people think. And I was saying I think it's going to be coming in late this year. Well, now I have a feeling they might actually start preparing even tomorrow. I think tomorrow is going to be a 50. I don't think it's going to be more. And I think the verbiage is going to be certainly on the dovish side. That's what I think is going to happen. But having said all that, I think we're coming closer and closer to the time when the Fed will U-turn. Will it be tomorrow? I think that's a little bit aggressive, but I think there is a good chance that they might start giving us some dovish tones tomorrow. If they do that, obviously you want to be buying cryptos, stocks, everything. But Bitcoin, we saw went to 21K. I think it briefly went below. I think that's the level that's getting defended very, very strongly. And we know Michael Saylor's MicroStrategy have a margin call, or they need to post more collateral. He said that he can post more cryptos. So it could end up being nothing, but it's definitely a very important point. And it was defended so far. I think if we see more equity selling, which I think it will happen, that's going to go. So do I think we've seen the bottom? I don't think so yet. Unless the Fed tomorrow changes, excuse me, in a big way, then I think we've seen the short-term bottom, or maybe even a medium-term bottom for sure.
You don't think there's going to be further fallout from what is actually happening in cryptos rather than being a consequence of other markets and risk and whatever? Is there problems in crypto area that we were speaking about yesterday? Exchanges going bust and that sort of thing, and people losing a lot of money, margin calls. You don't think it's going to snowball? Or
I think we're way too close to the Fed now. The Fed's going to dictate what happens in the short term. But yeah, I mean, we've seen exchanges not allowing withdrawals, and people have obviously lost a lot of money, and that's really not good. And I think that this move lower is going to be the beginning for regulation, because so many people have lost so much money that there's going to be governments who are going to say, right, this is now too big. It was what, 4 trillion market cap at the peak, cryptos. So it's huge. So it has to be regulated. It has to be controlled. The people have to be protected. That's how they're going to say it. And regulation in crypto for me is the beginning of the end in terms of what its use is. I think I wrote it on the chat room. I know people are going to hate me for saying it, but I think that cryptos are going to end up being a collectible. Like the baseball cards you have in the US, rare cards and rare this and that. It's going to be a finite amount collectible that's going to have value because people are going to want to own it. But I think it's going to replace the euro and the dollar? Of course not. Do I think it's going to be a way to buy stuff with? Look at now. I think it's less than 0.5% of crypto transactions that are used to buy stuff. So I don't think that's going to be used either. I could be completely wrong. And people could say, "No, you're absolutely wrong." Yes, I accept that. I could be wrong.
Well, just one last question. That was something I asked on the chat room was what actually becomes collectible? Is it going to be just like a 100-digit line of code on a USB stick? It's not.
Yeah,
what is collectible in the crypto world?
The ownership of something which is digital. That's it. It doesn't matter what it is. It's like having an ape JPEG that you can save on your machine. It's still ownership. Bragging rights. That's all it is for me. Yeah. So that I think is going to become a collectible. The question though is how many of the 15,000, however many coins there are going to survive? I would say a handful. Almost literally. I know I'm going to upset a lot of people by saying this. That's my view. I could be completely wrong. That's my view.
Yeah, and well appreciated as always, mate.
My pleasure.
So let's switch it over to what went on yesterday, and obviously the big thing that happened yesterday was a big run up in yields, a big break up in yields. We saw this across the board, and as I mentioned earlier, we saw JGBs moving up as well. Still not sure what actually happened in there, whether that's a fake print or whatever was going on. But the yield move is coming in alongside the market getting really hawkish. And I mentioned this yesterday that I think the market is getting too hawkish, and that's exploded. People are saying now 75 pips is nailed on, 100 pips is a distinct possibility now. And there was a story out from the Wall Street Journal, one of the reporters. Let's see if I can knock that up, find that for you. Where is it? And it really, now there used to be a guy called John Hilsenrath who worked at the WSJ during Bernanke's time, and he was said to be either a Fed member or really close to a Fed member, because he used to get gold. He used to get the stuff, the expectations. If the Fed wanted to communicate outside of normal channels, he was the guy who did it. And so if you got a story out from Hilsenrath that the Fed were looking at this or looking at that, you took it very seriously. He had a big reputation for that. So this guy's come out and he said, that they may be looking at 75 pips. They're considering other information, that sort of thing. But this guy isn't a Hilsenrath yet. Whether he develops into one, I don't know. But a lot of the market is jumping on board with this at the moment. To show an example, Goldman Sachs even mentioned it in one of their notes. And I'll get that for you as well. Here we go. the first thing they mention, they're raising their forecast to include 75 pip hikes, and the first thing they mention is this article from the WSJ that Fed officials are likely to consider surprising markets. They say it's a departure from other articles that he's written, where he characterised such a move as 75 pips as unlikely. So their best guess is that the article is a hint from the Fed that a 75 pip hike is coming in June. So as I say, the market is really getting bulled up on these higher hike expectations. And as I said yesterday, what that's doing is it shifts where the risk is, or it tells us where the big price risk is. If the market hikes 75 pips, it seems half the world is expecting it. So we've seen this big jump up in yields already. That's likely partly as a result, or big part of the result, of this article and these expectations changing. So how much more can be done if they hike by what people are expecting? How much upside can there be? It's almost all priced in. So that puts the bigger risk for price moves to the downside in things like the dollar and yields, because if the Fed disappoint, if they don't deliver 75 pips, the market's going to have a little freak out, and we're going to reverse a lot of these moves. For me, I still think the market's getting far too hawkish. I think the Fed are going to go 50 pips, and they're going to reiterate their line to continue with maybe another couple of 50 pips. I think the main change potentially is that they give a stronger line on that 75 pips or more can be used further out if conditions change. They've already mentioned that in the statement. They're prepared to act as conditions arise. And as I said, I was talking to someone else this morning, and I was saying, everyone's going 75 pip hike crazy because of the inflation last Friday. I said, what happens if inflation comes in next month at 7.5 or 7%? Are they then going to suddenly switch to 25 pip hikes? Central banks don't do that. They don't flip-flop on the size of their rate hikes. They like to get into a path, let the market know what their path is, with the caveat that they can adjust as necessary. But I think it's far too early for them to start slamming on 75 pips and even talking about 100 pips. Because the other thing we know, the Fed Powell wants to do this soft landing. He wants to see rate hikes impact the economy, but not to crash it. You suddenly start going from 25 to 50 to 75 to 100 pip hikes, you are going to see a crash. And I don't think the Fed wants to do that. So for my opinion, and until I hear anything else or something changes, I think 50 pips we're going to get. There is potentially a high risk of 75, but I think it's going to be 50s. Carry on with their path, but leave the door wider open for higher rates hikes if they see fit further down the road. Kay, I don't know if you got any, or Stel got any.
Well, I think the real risk for tomorrow is 75 BP, but what I would also would like to guard against is to get hyper hawkish. Don't forget QT is starting to run and even has to get into higher gear yet, and the Fed might say, like, hang on a bit, rate hikes is fine, but QT is going to mechanically put rate hikes in there as well. So yeah, 75 is possible, but I would think that they are, as I've been saying as well before, they engage on a certain path, and they would want to keep that. They're also seeing what the market is pricing and how the market is moving. So they may go 50 and then disappoint people who were thinking about a pause in September. Instead of doing 75 now, just go steady Eddie, and just continue to raise.
Yeah, cool.
Because the market has already priced it in, so there's no on the bond side of things. There is, I don't think, too much risk of the market collapsing if they stay on their path. So and it's best for them to stay on their path. So the market reprices a little bit the short term, and then the curve gets a little steeper again, because a flat to inverted curve, it might be for another discussion, but it's not good for assets either. So they have seen what happens to the curve. We're basically inverted or nearly inverted from the short until the long end, and the Fed will see that.
Yeah, I agree, and I think you're obviously 100% right. I'm not saying that there will be any sort of collapse if the Fed disappoint, but things are very volatile at the moment. Seeing yields spiking up to 3.4%, 20, 30 pip moves is big for the bond market. So, if they do disappoint, I can see yields, maybe coming down to test 3%, that sort of thing. But no, we won't see a collapse. And on the flip side, what's happening in dollar yen, again, we're seeing a bit of we're not seeing this pair particularly, or yen at least, on the bus with US yields again. US yields break new highs and we can't even get up to 135 again.
Yeah, but I think
there are other factors involved, which I'm certain you're going to add to now.
Yeah, I think now we are like pre-Bank of Japan, and the finally the drop in assets like the stocks and such have had an impact on risk, right? When we look at the yen pairs on the cross side, and dollar yen did not move that much, let's put it that way, in the context of the past few months, but we are staying just 1% below the highs, or less than 1% below the highs, but all the yen crosses have been coming off, due to the equity markets come off, and also due to this the curve. The curve, the US yield curve, has an impact on the yen and on the Japanese investors. So if the yield curve inverses, usually that's not great for yen pairs. So I think there's a kind of a logic, because Bank of Japan Kuroda still banging on and buying record amount of JGBs overnight again, is keeping the yen weak versus the currency that everybody wants right now is the dollar. But we have to be a bit careful. And there was an interesting article, by the way, in the Nikkei last night, saying that some of the Bank of Japan watchers were actually looking at it in a way that everybody says, "Oh, what a gaffe!" and he got slapped on his fingers by saying that the consumer can weather higher prices. But now some of the watchers, Bank of Japan watchers, is saying that there might have been a message in there saying that, well, higher prices might also mean higher interest rates. And so there is still, I keep a completely open mind for Bank of Japan, even though they are like digging their hole, not with a spade, but with a heavy duty excavator right now. They might still start to do something come Friday. I'm not saying that they will straight away hike rates, but they might do something with the maturities, the length of the maturities on the bond buying. They might cut down on their bond buying. They might widen the bands. What would be, if they don't do anything, the yen is going to get slaughtered again, right? But and depending on how they lengthen the maturities or shorten the maturities on the bonds will also be very, very important. But I guess we'll talk about that on Thursday, right?
Yeah. And this is a good point you make. When we get into these weeks, these big events, Fed, Bank of Japan, Bank of England, from a trading perspective, you got to take more caution, because like we say with dollar yen, it's going sideways at the moment, and that could be purely down to everyone's waiting for the Fed and then waiting for the Bank of Japan. So when you're trading it, you don't want to get sucked into maybe a false sense of security that we've seen a top, we've seen a bottom in the short-term pricing, when the market may just be sitting on its hands a bit, and we get the explosions around the big events. So just something to be wary of when you're trading, and myself, and I know Kay does, we tend to retreat a bit into our shells with these risk events, because we don't know what's going to happen, and it is a big volatile event. And first and foremost, we need to protect our accounts, and if that means we hold back trading significantly in any particular pair, that's what we'll do. We're not scared of missing something just because we're urging a bit of caution. There'll always be another opportunity, or you wait for the event to pass and you analyze what's happened, and then you pick a side and pick a trade. But if you find you're looking at these big events as a trader and thinking, yeah, this is going to be huge, we're going to get big price moves, I need to be in that. And when you come at it with the I think XYZ is going to happen, that's when things become dangerous, because it doesn't become real trading, it becomes gambling. You pick a side, you think something's going to happen, and all you're basing your trade on is what you think. And no offense, but what you think, what I think, what Kay thinks, what Still thinks, what anyone thinks doesn't mean shit. The market is going to do what it's going to do. The Fed is going to do what it's going to do. Even if you think right, fine. Next time you think, you might be wrong. So don't leave it to I think. Leave it to what the market tells you, what the Fed tells you, and if need be, trade after the event. But anyway, that's a quick little bit of advice there. Quickly on Arif, he said, what can we believe what these analysts say they're using to exit positions themselves? What you got to remember is a lot of bank research and that sort of stuff, they're not trading, or if they're trading, it's paper trades. They are there to provide a service for customers, and if they get customers trading through them, that's how they earn their money. So you've always got to think that bank calls and bank forecasts are pretty much a sales pitch, and it's a prestige thing as well. They want to be right, they want to be seen to being right. It's a good advert if they've got an analyst who calls it well fairly often. There are some good analysts out there, don't get me wrong. I don't believe the majority of forecasts I read. They're always changing, and in my mind, if you have to change your forecast every month, 2 months, 3 months, the forecast wasn't very good in the first place. If you can't sit on a forecast for your period, 6 months or something like that, then it isn't worth toffee. We saw it with the RBA, we saw it with the Fed. Everyone's gone from super dovish to now super hawkish. That's the way the pendulum swings these days. But there are good analysts out there. There's good analysts who explain what's going on. You get a good feel for the market, you get a good feel for sentiment. So I'm not dissing them entirely, I'm just dissing their forecasts aren't worth the paper they're written on usually. So let's look at, I was looking at dollar yen there. I've got those two trend lines in really just as a bit of a visual aid rather than something to trade off of, just to see how the trend's developing. We have got a shallow uptrend still within this range. Want to see where the levels are. My main range is still between that highs in the 135s and 133s. That's where I think we're going to potentially move in between, at least up to the Fed, and then we'll see what happens after. Again, if we do get whatever the news is from the Fed, if we can't break any of those levels, then potentially the market's well comfortable with where it's at with the Fed path and everything else, and then we look to see whether we're going to consolidate for a bit. If we do start breaking these levels, if we do break 133, what happens after? Does it become resistance? If it does, then that gives you your opportunity to trade. Same on the upside. If we break the highs and we find that level then holds, then it gives you conviction to carry on with longs and see where it goes. So it's really about the price action telling you what to do. Again, don't guess. It's all there, plain to see. It'll tell you what it wants to do. If it breaks 133 and doesn't hold, well, things get a bit messy. You pull back a bit, you let it do its thing and see what develops. So yeah, I've got those trend lines in basically just as a visual way to see. Funny enough, after I drew it, it held the trend line here. So it just tells me that the market is, happy to buy on the dips and sell on the rallies and not go anywhere too significant. Euro dollar, that took a bit of a pasting under 105, but it's a bit volatile, a bit more volatile today. We had the break under 105. I was long into that. The first test, caught a few pips off of that, then got done on the trailer. Not really touching it at the moment, though it has held the big figure down at 104, which is probably a bit of a line in the sand before we get a test of that bigger 103.40 area, which is the big long-term support area. I think 103.49 we got to in the last dip. We have come back here very quickly, so that is a potential worry, and particularly after the ECB has confirmed its hike path now. So it tells you that the Fed is still the game in town. this will be very interesting if we get a move down to this low and what happens here. If we do get a bounce, that could be very significant. It would mean, once again, like we were here, we've perhaps priced whatever the Fed is going to tell us on Wednesday. And then we see another bottom put in play, and that'll be a very strong potential double bottom. And then maybe we get a rally back up towards 107. So an area I'm going to be looking at, again, if these sort of levels aren't broken over the big events, then that gives you a clue that that's the time to maybe try a trade. Kay, you looking at anything in euro dollar at the moment?
No, exactly the same levels. I think the rejection from 108 after ECB was significant, and now we've come back down to roughly around the lows. It's all down to the Fed from here, I think, for the euro dollar. As such, this the euro has responded relatively well, because this is I think the reason why euro dollar is not much lower is that euro is a bit of a de-risking currency as well, and euro crosses have shot up overnight. So I think it's one of the reasons why euro dollar is here. But I wouldn't hang my hat onto anything euro dollar right here and now. I'm just waiting for the Fed to tell me what to do. Yeah,
and it feels a bit deja vu at the moment. Yeah, let's see if I can highlight that a bit. You know, we had a similar bit of play between the 105 and 104, you know, back in May. So potentially, I'm looking for a similar look at 105 to see if it's still acting as resistance. We know support is at 104. If you're inclined to get involved, then look to maybe play that range, and just watch out for any breaks either side to see whether they're going to continue or fake out. That's certainly what I'm going to be doing, particularly over the FOMC. Another one we've got a little break on. Hallelujah.
Ryan, can I just say one more thing about the euro dollar in the longer term? The rejection at 108 was exactly the same as the rejection that we saw on the big bounce to 115. And remember, we were saying like that was well before the flow show started, but I was saying like people were looking for a deeper bounce in the euro, and we did like the same kind of thing from 111 to 115 that we saw from sub 104 to 108. It reminded me exactly of the same setup, and I said in those days, yeah, but we first have to go through 115 before we can talk about a bigger euro rebound. I think the 108 now, or the 108 figure 30, is our new 115 for the medium term. That is my firm opinion on that right now.
Yeah, 100% agree. And even then, 109.40 is another area we've been highlighting a lot, but very much so. You know, it's and I said this last week. I said it on Face. If we can't bust this level up here on the ECB, then you know, there's only one way. If you ain't going up, there's only one other way it can go. Though even I wasn't expecting a move, you know, this big down, particularly on the ECB, haven't confirmed they're going to hike rates. Yeah, there's still divergence in play, but again, a lot of this is on you know, these rising Fed expectations. So again, if the Fed disappoint, I can see this shooting right back up to 106, maybe getting back in a 106, 108 bracket again. But we'll see. You know, let the price action do the talking, as we said. And yeah, switching to another pair, as I was going to say, you know, hallelujah, we've got the break. You know, we've been looking at this a long time. I'm still running along. I know Kay, he had a buy stop in at 10 that got filled in this move. I didn't get on the buy stop, but I watched it, and I think we moved up to 11, 12, a high like that, and then we came down and tested into 86, and I bought it 86.02. Bit of a short-term play, and to add some into my core long if it plays ball, and I get out of sort of half the position for you know, maybe 20-30 pips, then I'll look to fold the rest into my core long. But yeah, it's at the moment it's looking like we've got a plausible break on. So where can it go from here? You know, as I say, technically it looks perfect. We've had the resistance, we've had the break. It's now shown signs of support into the 86 level. That's what you want to see. That gives you your confirmation of the break. And now we look for the next levels above. Pretty wide gap. We've got a potential bit of resistance right here at this 86.20 level. It's come out a bit because we need to do a lot of in and out on this one. 86.20, yeah, it's been a bit of a level on off going back. So this is the next area to watch. For me, then it gets up to the 86, 60, 70 area, another little zone to watch that we had 3 highs made there. Again, it's been a historical level. And then we get up to the 50 fib of the big 92 move down. That's in the 87s, another big level. These are, like Kay said, it's all about prices taking the steps. At the moment, the 86 is a big level, but it's a small step in terms of the wider move we saw down over the last couple of years. But yeah, if it manages to hold, then we see what happens here. And when you're trading positions like this, you've got to ask the question, what do I do when we get to 86.20? What do I do if we get to 86.60? What do I do if we get to the 50 fib 86.16, 87.16, the 87 handle? And that's how I'll be playing it. I'll be, as I say, looking to maybe take half off or maybe a third off, run the rest, see how far that goes while keeping a bit in the core long. As Delia said, he's looking for somewhere back up in the 90s. I think that's potentially achievable over time if the ECB stay on their path, if the Bank of England hike, but then maybe slow. If the ECB pick it up, get more hawkish by sheer weight of numbers, the ECB will trump the Bank of England in terms of flows, and this should continue higher. But one swallow does not make a summer. So while we've got a break and it's confirming, it's looking good. I'll keep my stop tight at 85.80 just on this trade, so pretty low risk. We're moving up into the 20s now, so I might have a little slice in a minute. Bring my stop up a few pips just to lock it in. But yeah, so that's the break we've been waiting for a long time, and it is looking a bit solid at the moment. We'll see where that goes. Another euro pair, doing a lot of euro analysis today. I've jumped on Kay's back. We were looking at this yesterday again for a possible break. I know he's in with sell stops. I'm in with a sell stop 33.80. Do you think there's some institutional or corporate interest here, Kay? Because it's looking very solid down here.
It is looking solid, right? That's the 4th attempt that we had at this 134, 133.90.
Over a decent time as well.
Yeah, and it is rock solid. I was actually yesterday thinking of buying it and with a stop and reverse below, but then the price pretty quickly actually moved away from the level again, and I didn't get in. Would have been a nice trade, but it is rock solid down there. So, but if it is rock solid, the break would be equally strong, right? So we need to keep a very, very close eye on that level if we get other retests. But yeah, it is rock solid down there. So there must be some flows down there for sure.
Yeah, and that's a good point. When you see strong bottoms like this, first attempt, if it level, second attempt, yeah, I'm can be confident trading those. But if we get a move back down and we start hitting it in quick succession, that's when I get a bit nervous. And you take the move as a whole. We've been trying this since May. When you get a level that shows up to be such a big level, then you've got to think that the longer it lasts, the bigger the reaction is going to be if it does break. So that's why I like to play with buy stops and sell stops, because what I'm looking for is that if it does break, you get a good, decent blow through, and it gives you some decent pips. Now, of course, you can still get a fake out, a little break, trips some stops, clears everyone out, and then it bounces again. That's the risk. But the more times a level's tested and the more times buyers keep buying off of it, you know, the bigger the stops are going to be growing underneath it. That's why you tend to get a more volatile move when you get one of these big levels breaking. So yeah, I'll keep my sell stops in there for a while longer just to see what's going on and see what happens. But I'm also going to be watching the bounces. You know, if we can't get back up to sort of these 138s, if we start making a series of lower highs and keep coming down to the level more frequently, you know, the warning bells are going to start ringing for me. And yeah, then we'll see what happens on a break and where it goes to. Do you want to? I know we didn't cover it yesterday, the metals and some of the other EMs, you know, dollar mix. Do you want to take the screen over, Kay? And
yeah, sure. I can do a quick
give your thoughts on those.
Yeah, sure. I'll do a quick update on those.
Let me stop that. Right, all yours, mate.
What is going on here? Okay, where's my? There it is. Can you guys see it?
Yep.
Can you see it? Okay. No, I was actually looking at euro sterling, right as you were looking at it as well. There's this trend line from the highs. Okay, it's only a 2.5 point trend line. When it's coming in around 86.80, which is also going to be one of my levels that I'm looking at. That for the euro sterling. Yeah, I'm long. I was long before trying to play this 84.80, 85. 80-90 range from the long side and keeping some longs for a possible 86 break, which we are getting right now, but okay, still a bit shy. Right, on the metals, we had this this zone I was pointing at the other day, 75.80 capped in gold. Then we went back down below this little trend line, and we tried to hold the 1828 for the first time spike, but then yesterday, under the weight of a much stronger dollar, the thing broke, and we had a low of, I don't know where it was, like 09 or 10 or so. And this morning we tried to get back into the 1830s on gold, but it's looking at that fragile. Is this a new range? Possible with the highs around 45, around the 200 DMA. Is possible that we are trading like 1805, 1845 for a while. But again, the Fed tomorrow should be a decider for this one. Silver, well, it just goes on. Every attempt above 22, every attempt to break clear from this 22 figure 15 zone gets sold again. Then we had a look at this lower trend line. There's a decent support, in my opinion, between 2090 and 21 on silver. There's a bit of decent support. If that goes, then we could quickly see it back to 20.5. I'm well, barring my ultra long term, really small long. I'm not carrying anything in there. Stelios did a good buy just from the 21 line, and I joined him yesterday. We had a quick 30 cents out of it, which was always fun to have. And but for the time being, waiting for hopefully not Godot, but waiting for what's to happen. EM currencies, wow, they got absolutely smoked over the past couple of sessions when it became clear that that the risk assets were going down, and the dollar yields and other yields were flying. So I tried to give it a bit of a short try yesterday around the 200 DMA, but that didn't work. So I quickly cut it. I don't really know what to expect from it. We could go up to either mid 2060s up to 2080 possibly on the dollar mix. 2080, even if we touch 2080, it wouldn't change the longer term channel. So around there, depending on what Powell may say, I might try to give it a short again, but then we need to leave a little bit of room up to 21 nearly to see if it's a false break or not, if we would get a move above.
Just before you close that chart, Kay.
Come again?
just before you close the MEX chart, those moves within those trend lines, they look quite interesting because they look like they come around when we've had changes in Fed expectations or news from the Fed. You know, when I look at the patterns like that, you know, we get a big spike up and it runs out of steam and doesn't last, rather than we see a lot of sideways action. It's a bit messy. It doesn't quite get up there. It doesn't quite get down there, sort of thing. So yeah, just looking at that chart alone, I think I might piggyback that one as well. When up in the, if we get in the high 20s.
Yeah, in the next, it's actually roughly 1% away from here. Is it going to hit it before the Fed? I don't know, but I think I might be giving it a try again, especially that it would also coincide with the break line of a prior support, which we retested and failed, held here, and then we bounced. Okay, here is it's a false break here. We collapsed through it, but then we went to retest it and failed again. So we've got a double interest here, in my opinion, around 2018 in the dollar mix.
Yeah, cool.
All together with the big one, which is coming from 2017, this red trend line on the downside, which held again. So we've got like pretty decent levels there to look at in that pair. The dollar rand did exactly the same as the dollar mix, but the picture is a small different. We tried a couple of times to break a trend line, but it took a while, but then still reversed on the next day. I think we are looking at this zone again, which is anywhere between 1632 and 1636 as a major resistance, which held once, twice already over the past 7 to 9 months. So pay very close attention to that zone if you would ever get there in the dollar rand. Get back below, I'd say 1587.90. The party may be over and we go back down. That for the rand. On the Chinese yuan, well, I was long again, as people know. I took my profit yesterday right here at 675.40. It overshot a little bit into the next resistance, but 678 to 679, call it 680, as it's an EM currency still. We have to give it a little bit of leeway. Is a decent resistance area. 1, 2, 3 tops, 1, 2 here as well, and a few more here. So pay close attention to this 78, 79, 680 level. On the downside, we went back testing 672 early doors this morning. I'd say if it holds 672, the move is still rather up, but I'm not going to take a new position before the Fed, at least. If we would break below 670 and hold it, we could get a look back at low 660s, in my opinion, on the dollar China. So neutral for now. Keep an open mind. But
so what's your view of being, just from a education point of view, what's your view of being neutral now rather than buying the dips? You think because we're getting these higher lows, the margin is squeezing out a bit, not giving you too much room to play in?
That for one, and for two, of course, I don't know what the Fed is going to tell me tomorrow. My bias is still to be short CNH at some point, because I think the PBOC and the Chinese government, even if they try their zero COVID plan, it's probably not going to work very well, and PBOC will continue to ease, especially as the economies will reopen. That's where they are probably going to press the button. My overall view is that we could still hit 7 in dollar China, but perhaps not now. And I'm keeping a very open mind right here and now.
I completely missed that move up yesterday. As I've been saying, I've been looking at that 679, 680 area. Completely missed that one yesterday.
Yeah. And the last one, but this one is really shying away from the levels. The last one I was looking at was this 20, 80, 85, 90 zone on the euro mix. But euro, when it's risk off, we have to know that euro sometimes can be stronger than all the rest. The ultra low yielders, when it's risk off, tend to behave better. And yeah, we'll see. I don't know what to do there. If it gets up to 28, 2180, anywhere between 2180 and 22, I think might be a good zone to start to look at some shorts again. And that's it for me for today. I'm looking at the time. We're already running quite low.
Yeah, there's just one other thing I want to look at, which I think could be significant today. I'll take the screen back over. It's just in the S&P. You know, been looking at this level for a while now. This fib level, the prior low 38.11 into the 38 handle. We got the break yesterday, and so far it's confirming the break. We've had a move back up to it. Couldn't quite get above it after the break below, so we broke the 38 handle. We got back up close to it after this initial move below, but I think from now it's technically it's doing what it should do. It's had a break, it's confirming the break, it's holding the break. Potentially further downside to come, although you know we did get a fairly decent move yesterday. So it's a question again, is this going to continue? As long as the S&P holds this area, this prior fib and resistance area now, then we should see further downside. And then we're potentially, you know, we're looking quite further down. I think it's, you know, going to be the low 37s, maybe even more. Potentially a move down here to the 50 fib. We were going to have some various points along the way, of course, but in the wider picture that I tend to look at, that's where we can be looking. A lot of people in our room, and Kay's mentioned it as well. You know, if we do get down to under 35, maybe down to the 34s, is that going to be a point in which the Fed start taking note and we start getting some more comments about the might pause rate hikes and whatever? But just for today, as I say, that's one to keep an eye on when the US comes into play. Yeah, that's it for today. Hope you enjoyed the show. Thank you very much for coming. Tomorrow, obviously, big Fed day, so we'll have lots of views on that, no doubt.
I wish you
day. It's what?
A big fat day.
A big fat day, definitely a big fat day, and then a big fat Thursday and a big fat Friday. Feels like it's Friday already and it's only Tuesday. So anyway, yeah, thank you very much for coming to the town. Hope you enjoyed it. Have a good day's trading, stay safe, and we shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.